Hey everyone, and thanks for jumping back into the cryptoverse. Today we're going to be talking about Ethereum, and we're going to be looking at the risk metric of Ethereum. We have not talked about it on this channel in about 2 or 3 months, so I thought it was time to give you guys an update. If you guys like the content, please subscribe to the channel. Also give it a thumbs up, and if you'd like to talk about these charts, I'll post 1 or 2 of them in the Telegram channel, which you can see here in the upper right hand corner of your screen, or find a link to in the description below. We have almost 3,200 members, so go check that out. So if you're not familiar with this risk metric, it's just something I use personally to weight my moves in and out of the market. I did a video yesterday of the Bitcoin risk, and the risk metric for Bitcoin is a little bit better optimized. I can say that because it's true. And the reason for that is that we have a lot more data for Bitcoin. It's been around for 11 years now. The Genesis block being in January 3rd, 2003. We have price data back to 2010, at least reliable price data. So we have a lot more data, and there's a lot more confidence in the risk model. In the Bitcoin risk model, it accounts for diminishing returns and lengthening cycles. So we would expect reduced macro level volatility over the long haul. So it accounts for this. Because if it didn't account for this, then the gauge of the risk in each cycle would change, because it might be expecting a bigger dump or a higher rise in the price, but it's never coming because of the fact that we're seeing reduced volatility and diminishing ROI. So with Ethereum, it does not take that into account yet. I'm hoping to transition to doing that with Ethereum, but there's just really not enough data to really adequately dive into that with a lot of confidence. So instead, it's more of a general approach. But again, I will look into optimizing it a little bit more. But if you're unfamiliar with this, essentially it's just defined as going from 0 to 1. So it's just normalized. In this way, you can identify hopefully the pits of the bear markets fairly easily by just looking to see when the risk is between 0 to 0.2. Because when the risk is in this regime, we don't stay there very long, and it's usually just a matter of time before we start moving out of this risk regime. Alternatively, on the other hand, if the risk is, say, above 0.8, then you're looking at a time that you likely should be selling your at least part of your position. And on this channel, I'm not going to go into it in depth on this video because I published enough videos that talk about it, but we talk about the idea of dynamically dollar cost averaging in and out of the market using the risk metric, so that it weights your buys at lower risk levels higher, and it weights your sells at higher risk levels higher. This way you can optimize essentially your long-term swing trades in a sense. So this is the basic the basic synopsis of the risk metric. You can see it goes basically from inception all the way to present day, and you can see several times where the risk was flashing up in this this upper region up here, indicating that it was getting close to a time to sell. Now I like to take the color coded part out so you can numerically see what's going on, and again it looks different than Bitcoin. It's not the same. But you can see that in each cycle, and note that this is just one cycle of Bitcoin in a sense. So I mean, these are sub-cycles within the Bitcoin cycle. So you can see early on, back in January of 2016, the first quarter of 2016, this is when the Ethereum price really started moving. We're going to look at this a little bit later in the video as to what was going on during that time. We've covered it before, obviously, but we'll talk about it later in the video. And you can see that the risk level came up to around 0.8 or so. It then retraced for the better part of a year, and then ultimately shot back up to its maximum value that it's seen. So the risk basically was, this is defining our maximum risk, because the shorter term volatility has been unprecedented during this time. This is why this risk level is higher than this one, because clearly this move from here to here is much more substantial from say here to here, and there is a significant period of time between this peak and over here is about a year. So it starts to reestablish where the risk is if it can continue to support itself at a certain price point. But the general idea is that if you dynamically dollar cost average your sells, say starting at 0.5, and you just incrementally go up, then this should help you maximize your profits while at the same time admitting to yourself that you'll never time the top. And just admit that you're human, admit that, you know what, I'd rather secure profits than just, you know, take this all-in approach. A lot of people say they're going all in on something. It's completely ridiculous. The idea of that, you should really, I mean, this is not financial advice, but I mean, as far as I'm concerned, no one should ever go all in on anything, because you're just, your risk portfolio, you know, that your risk assessment is just through the roof. So it's better to diversify and look at it that way. So essentially the idea is, you know, you could start selling at a risk level of say 0.4, potentially, because, and we've talked about this before, for Bitcoin I more so sell when the risk is getting to around that 0.5 regime, so above 0.5. With Ethereum, you know, because it's not optimized for diminishing returns, I don't actually think that this risk metric will predict a risk level between 0.9 and 1. I think it's more likely to be between, say, like 0.8 and 0.9, or even 0.7 to 0.8 at the peak. And because of this, we've talked about this in many videos, because of this you can make a good argument to say, okay, well, at a risk of 0.4, when we get above 0.4 is when you should start considering selling a small position. Not a lot, but if you're doing it dynamically, it would be a small portion. And if you did it, say, using, say, y between 0.4 and 0.5, 2y between 0.5 and 0.6, this would add up to 21y, so you would just essentially take 21y equals the total number of Ethereum that you hold. So then whatever the total number you have, you divide that by 21, and that would be what you're selling in this risk regime. And then 2y in this one, 3y in this one, 4, 5, and 6y up here, if it were to get there. So this is basically the idea. Now you could also do it statically. I mean, you could just sell a certain percentage at each risk point. But I do think there is some merit to say, you know, at least considering selling when we're above the 0.4 to 0.5. You know, in this risk regime, and you can see several times we came up into that region and then ultimately came back down. It's happened several times. So this is just something to consider. It's not necessarily set in stone, and you can set whatever risk tolerance you're okay with. But ultimately, you just need to find something that works for you and stick to it. Because if you don't have a plan, then you're going to go into you know, a futuristic bull market, and greed is going to overcome you. You're going to be filled with this, you know, FOMO in a sense. You're probably going to be continuing to put more money into the market. Your family and friends are going to think you're a genius, and then one day, you know, things will come crashing down, and then at that point, people are probably still thinking you're a genius and that you're unbelievably wealthy, but yet you're probably more so thinking, you know, I wish I had sold. So, you know, at least this metric allows you to systematically take profits. It's not based on emotion. So just take it into consideration. And by the way, if you want to, I do post these videos periodically. I think the last video I posted on this was 2 or 3 months ago. But if you want, say, a live risk value, I do have a premium content channel, essentially. So you can just go to intothecryptoverse.com and sign up. And if you pay with crypto, you can get a discount because it'll charge you for 6 or 12 months. Alternatively, you can also go to patreon.com/intothecryptoverse and sign up that way, and you would get access to the live risk metric for Bitcoin and Ethereum, as well as logarithmic regression curves, private Telegram channel, access to these Google Sheet documents that have other stuff on them, and a weekly report that'll show you the risk levels and talk about them, among other things. For instance, in the last report, we talked about, statistically speaking, you know, what's the best day to buy Bitcoin, and in the next report, we'll talk about, okay, well, historically speaking, what is the best day of the week to buy Ethereum? If you were to set up a dollar cost averaging approach and you wanted to say optimize that just based on prior data, how would you do so? So that'll be the topic of the weekly newsletter that will be released this Sunday. So if you're interested in that, then check out either intothecryptoverse.com or patreon.com/intothecryptoverse. So let's continue on here, because you know you can see that when the risk level drops down to these levels of below 0.2, it's historically when you really should be buying. and it's only happened twice for Ethereum so far. And currently we're ticking our way back up to that 0.4 risk regime. So it's not that far away. The current risk level for Ethereum is, I think it's around 0.36, 0.37, somewhere around there. So, I would say come up with a plan, whether it's using my model or someone else's model or something you make up on your own. It really is important that you come up with a plan, because you want to be able to look back in 2 or 3 years and know that you went into the market with a plan, you capitalized like you were planning to, and you now have a better life because of it. But again, this stuff is not meant for day trading. If you're going to say, if the price goes down one day and then you're going to freak out and capitulate, or if the price goes up one day and you just put a ton more money in, this is not for that type of investor. It's more so for people who are macro level traders who want to slowly move in and out of markets over the macro scale, rather than trying to lose all their money day trading. So this is the general idea. So I wanted to put these tubes side by side so you can see them. So up here we have price. So this one is Bitcoin, and then this one is Ethereum. And I guess I accidentally cut it off here because it goes below this, but you get the general idea. That you can see there's definitely some similarities here. It is interesting that if you look at, say, this peak, and then again here, it looks very similar to this one with Ethereum, and then the second one following it, and then you can maybe associate this move down with this move down, and we've talked about this. This is how, if you look at the logarithmic regression equation fit to non-bubble data for Ethereum, and you measure the percent difference between the price and that primary regression band, and extrapolate it out to 2023, and then look at the fair value of Ethereum at the time. The fair value would be around $1,000, and then the speculative bubble, if it were to continue to follow Bitcoin's path of diminishing returns, then it would put the price of Ethereum at around $10,000. So basically be about 10 times overvalued in 2023 if it were to continue to follow that pattern. So that's where or at least I came up with that number. It wasn't just something that I said, 10,000 sounds like a good number, I'll just say that. It was 10,000 seems reasonable, considering past data. Obviously, past data does not guarantee future returns, we know that, but at least we can use past data to inform our future investment decisions. If you choose to take the opposite and say, this is what it did in the past, therefore I think it's going to do the opposite in the future, then you can do that. There's nothing wrong with that. But we're just using past data to try to inform how we proceed, in a sense. With that said, let's continue on. I just wanted to quickly show this. So this is the Ethereum Bitcoin risk. So it kind of shows better here, like the peak, the sell, the big sell zone here. But this is with respect to Bitcoin. So essentially, this means back in 2015, Bitcoin got above the 20-week moving average, but in the short term, Ethereum ratio with respect to Bitcoin, it first went down a little, and it went up, it came back down, and then it went up by like 1,700%, or I don't remember what the exact percentage was, but we'll look at it in a minute, I guess, but it went up significantly. And then it was flashing the sell signal, but this was not sell to fiat, it was sell to Bitcoin. And then again, down here, it got back into the buy region. And then it went back up to the sell region. And this is again with flipping between Ethereum and Bitcoin. And today, obviously we're going to have to talk about the elephant in the room, because, the elephant in the room is, okay, well, Bitcoin's going up and Ethereum, Ether's just kind of sitting humdrum. What's going on? And, we've looked at this before, so I just want to go ahead and pull it back up. So if you go back to back to 2015. So this is back in, let's say, October of 2015. So this is when Bitcoin first got above the 20-week before it subsequently held the 20-week moving average for the duration of the bull market. Okay, so middle of October 2015. If you go to the Ethereum Bitcoin ratio in October of 2015, you can see that during that weekly candle, it first went down. The second one, it went up a little. The third one, it pumped significantly. It then ultimately retraced back down. And then in the first quarter of 2016, you can see from January through March, this was when Ethereum made its move. And if we were to say take a measured move, it pumped, okay, so it was around 1,800%. And this was just with respect to Bitcoin. Now, remember, after Bitcoin held the 20-week, it took a while for Ethereum to see this move. So if we were to just say, okay, let's look at a date range between, say, October 12th out to when Ethereum really started moving with respect to Bitcoin, it was 91 days. So we're talking 3 months before it really started moving. And remember, if you look at the time it took, so Bitcoin first got above the 20-week in October, let's say October 12th of 2015, and then it started holding it as support right here. 105 days. So pretty similar. So 105 days, it started holding it as support. It was already holding the 100-week moving average as support, but those times were different. So looking back at Ethereum, you can see that essentially this move coincided with Bitcoin being above the 20-week and then holding it as support. This was what the catalyst was for the move. We've talked before about what does Ethereum need to see a move. And the catalyst is something that is necessary but not sufficient, is Bitcoin needs to be above the 20-week moving average. It doesn't mean that the minute Bitcoin goes above the 20-week moving average that you're going to see Ethereum pump. And we've talked about it, it could take a little while. It doesn't necessarily have to happen right away. So what we would want to see is either Bitcoin continue to stay above the 20-week, well above it. At some point, I would expect Ethereum to start moving. And especially if Bitcoin comes down to the 20-week and then confirms it as support over a multi-week period, then I think it's going to give more confidence back to Ethereum. But you have to remember that this is a game, a macro level game. It's not a daily game or anything like that. And we've also talked about, and this has been right 6 out of 6 times if you just look at past data, the idea was converting from Bitcoin to Ethereum, converting from Ethereum to Bitcoin, or say a stable coin when Bitcoin goes below the 20-week and then reconverting later, has worked 6 out of 6 times. So had you done that in the past, it would have worked out for you in your favor 6 out of 6 times. You would have ultimately ended up with more Ethereum than you had. If you had done it this past time, you also would have ended up with more Ethereum. Because if you look at the ratio, you can see that Bitcoin broke the 20-week on the week of March, what was it? It was March 2nd. It was this week. And then at the top of this candle, so basically right when it broke, the ratio was 0.0253. Had you gotten in when Bitcoin went above the 20-week moving average, so let's look at that. Let's go and look at above the 20-week moving average. The candle closed above it on April 27th. So looking here on April 27th, and then looking, okay, candle closed, the value is 0.0237. So you would have accumulated more Ethereum. Now, clearly in the short term, the valuation of Ethereum with respect to Bitcoin has gone down. So the other argument is that converting from Ethereum, or converting from Bitcoin back to Ethereum, obviously not all of it. Bitcoin is the majority of my position. It has always been, and it will always be the majority of my position. But Ethereum is number 2 in my book in terms of the where it stands in my portfolio. So what I'm doing is I'm just slowly moving to Ether as we continue to go forward in time, and Bitcoin stays above the 20-week moving average. I'll just continue to slowly move to Ether, potentially some from Bitcoin, also from stable coins, because I would be expecting a move from Ether. Now, if you look at if you had just say converted everything, which I know some people like to just go to this all-in approach, which I've mentioned is not a good approach, but had you done that in the past and taken this 20-week moving average as kind of like your switch that you flip, it would have been right all but one time. And the time that it would have not worked out would have been in April of 2019 when Bitcoin went above the 20-week, but ultimately the Ethereum Bitcoin ratio continued to bleed for the rest of the year. Even when Bitcoin was above the 20-week, Ethereum Bitcoin was bleeding. So, there's no free lunch. There's always a risk involved. clearly going below the 20-week has been right 6 out of 6 times. Going above it, if you were just say converting everything to the other, from one coin to the other, it's been right all but one time. We've shown that in prior videos. I'm not going to go through each case where it would have been right, but you can go back and look at a prior video to confirm. And this is why I say, everything's about slowly moving in. You slowly move into the market, and then you slowly move out. I think this is the best way to do it, and it helps keep you sane during all these various price moves. So at least consider this as a possibility. We know that last time it took Ethereum 3 months before it really started to break out. And I think Ethereum can break out again, but it is contingent on Bitcoin staying above the 20-week moving average. So if you see that break, then we're kicking the can down the road. And at that point, I would be converting out of Ethereum back to Bitcoin and or stable coins if Bitcoin were to go below the 20-week moving average. And when I say go below, I mean closing a weekly candle below, not just having a wick go below. I'm talking about closing a weekly candle below the 20-week moving average. That's the sign that I use. So with all that said, if you guys like the content and want to see more of it, again, I do have a premium list that you can sign up for. It's $50 a month. You'll get access to a weekly newsletter with risk analysis, valuation insights, and logarithmic regression, a private Telegram chat room, and access to Google Sheets with the risk metrics of Bitcoin and Ethereum, as well as for those people who like ADA, Cardano, the risk metric is also on there for Cardano. And then this one is for people who want one-on-one correspondence, the like telephone call or calls over Skype or something. And if you would prefer to not use Patreon, I also do have my own website, so you can check that out. It's just intothecryptoverse.com, and you can sign up using either fiat, credit card, or cryptocurrency. And if you sign up with cryptocurrency, it'll charge you for 6 to 12 months, as I said, but for paying up front, you get up to like a 10 to 12% discount for 12 months and like a 5% discount for 6 months. So, obviously, if you aren't interested in paying, I can understand. Definitely, at least subscribe to the YouTube channel, because I'm sure I'll post some update at some point in the future on this. So, subscribe to the YouTube channel. Give the video a thumbs up if you enjoyed the content. Leave a comment down below if you want to tell me your thoughts on it. You can tell me if you think it's a good metric. If you don't like it, just let me know what you think. And finally, check out the Telegram channel. We have we have around 3,200 people there, so come check it out, come chat with us. I'm pretty active there, actually, so if you want to talk, then you can find me there. Alright guys, that'll wrap it up for this video. I will talk to you next time. Bye.